Welcome to another edition of Top Tips Tuesday. Jeff here again from GCD Property. Now, this week's tip is for looking at the differences between investing in property inside a self-managed super fund. So general disclaimer there, I'm not a financial planner, so before you make any decisions on property in your super fund, the first point of call is always go to a financial planner. But having worked with a lot of clients over the years that have invested in real estate in self-managed super funds, I do understand the differences. So these are just some general guidelines and tips, so you're a bit armed with some information before you rush out there and get too excited and are looking at property, because not every property is suitable for a self-managed super fund, and there are some differences as well. So the number one thing, the property must be what's called a single contract. So I know we do a lot of two-part contract where we go through construction on investment properties. Outside of super, that works really well. There's some big savings there, stamp duty savings, tax incentives, but on a super fund we can't have a house and land package or a two-part contract, so it must be a built or finished property. Number two, you really want it to be positively geared, so generating more income than the expenses. The good thing about self-managed super fund is in a trust. It's very protected, very safe, but you don't want it to be a drain on your super fund, so you generally want it to be paying for itself. Tip number three is generally you can't do development in a self-managed super fund, so buying blocks of land and adding dwellings or construction on the property can be a great way to add value in a outside of super option, but within self-managed super fund it needs to be a more traditional type of property. Number four, you need a larger deposit, so generally the banks won't lend you as much in a super fund, traditionally around about 60 to 70% LVR, so you need a larger deposit in a self-managed super fund, and there is some rules around the minimums amounts that you have in your super fund before you can invest in real estate and compared to the loan value. So again, always go back to your financial planner, and just remember the interest rate for borrowing money for the property in the super fund will generally be at a higher rate than outside of super as well. So there's some pros and cons in there. It works really well, helps clients build their property portfolios if they're limited outside of super, but you really need to take some good advice and make sure that it is a good property. I'd always recommend modern, low maintenance type properties in a super fund. Again, you don't want to be drawing on those resources within that. So I hope that's helped, and if you need a great financial planner, reach out and I can introduce you to a very successful financial planner that's helped many clients over the years. Thanks, and see you next Tuesday.